Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I'm the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a former macroeconomist, and I currently serve as a certified financial planner and wealth advisor. Now, today I had the distinct pleasure of interviewing Dr. Charles Calomiris. Now, Dr. Calomiris, if you haven't heard of him, is a world-renowned banking and financial expert. He's even testified before Congress on matters of banking and financial regulation. He is one of the best scholars when it comes to understanding the financial crisis. If I had to handpick anyone to come on this podcast to really help you as a listener actually get to the heart of what happened during the 2008-2009 financial crisis, Dr. Calomiris is definitely at the top of the list. A couple things to note about him. He is professor emeritus from Columbia University. He holds a BA in economics from Yale, as well as a PhD in economics from Stanford. He's written exhaustively on the banking crisis. I call it the banking crisis because I think the financial crisis of 2008-2009 was really predicated on a banking crisis. But he's really an expert on those episodes, and he's written a lot about the history of banking crises. In fact, we're going to address his book today, Fragile by Design, that he co-authored. Okay, so this will be another two-part interview with Charles. So in the series on the financial crisis, this is episode 3. There will be an episode 4, which will be the second part of my interview with Charles. But in this one, I felt like the only way in which we can fully appreciate the 2008 and 2009 financial crisis is to understand the historical backdrop of systemic banking crises. Yes, we have been systemically prone to banking crises in the United States going all the way back essentially to our founding as a country. And so I think for you to really get the 08 crisis, you have to first understand what we were up against in terms of the United States system. We're going to talk about Great Britain as well and their systemic instability that occurred with their banking system as well. And we're going to go all the way back and look at what was this thing called a banking charter, where did it come from, and what were its intended purposes at the very beginning, hundreds of years ago, when the English government decided to start chartering banks to finance wars. So again, you're going to hear the first part of this interview, and then next week you'll hear the second part, which will really get into the nuts and bolts of the financial crisis. Charles, it's great to have you on the podcast. Good to see you.
Great to see you.
I'm looking forward to our discussion today. So we are going to discuss your book, Fragile by Design. And what I particularly loved about the book is that you create a real historical set of knowledge around why banking systems historically, with one exception, have been extremely fragile throughout, world history. And so we're going to progress to the financial crisis because I'm doing a whole series on the financial crisis. But I think to really get the nature of the 2008 and 2009 financial crisis, we need to know our history first. And it actually goes back several centuries to the advent of the banking charter in Great Britain. So let's start there, Charles, regarding the UK. So what are your thoughts? Can you help explain to the listener what the banking charter was and what the English were seeking to do back several hundred years ago?
So, first of all, thank you. And I want to even repeat what you said as our motivation, because I think that was very insightful. What we really need to do is we need to study history to understand where we are. And I just want to say it's because what's possible is determined by political coalitions. There's always a bit of a struggle over how the banking system is going to be grabbed and used. The possibilities of chartering banks will be used by government for its purposes. And so to understand what these coalitions that are battling with each other over that space, what they want and why things end up the way they do. How could you possibly approach that except historically? So now let's start with Great Britain. The important thing to understand about Great Britain, we're talking about bank chartering, is a modern phenomenon, by which I mean it's about what we call the modern era, which is the era of modern nation states. And Great Britain, after its glorious revolution of 1688, is now in this position where it is trying to compete as a latecomer on the world stage to establish its own colonies and its own empire. And it's competing with all of the existing nations. And then right across the channel, it's of course competing with France. And if you look backward from today, you would say, well, gee, that was the beginning from roughly 1690 until 1815. Britain and France were sort of continuously at war with each other. And so if you were going to say, what's one of the defining features of thinking about the history of Britain at that time, you would say a nascent country has this glorious revolution of 1688. Now it's on the global stage, trying to establish itself as an empire, especially in competition with another newcoming country, France. They're going to be fighting over, for example, North America. They're going to be fighting over a lot of things. And as the British are trying to establish themselves, they're trying to figure out tools of state. Tools of state have to do with, armies, navies. Mm-hmm. They also have to do with taxes. But the one quintessential tool of state is the chartering power over banks, being able to decide who gets to be a bank and to what purpose. And what's interesting is the Bank of England, which is chartered in 1694 by the controlling party of Parliament at that time, the Whig Party, is chartered very much with the purpose of funding the government's war against France. And that really is the defining purpose of the Bank of England from 1694 through the 1820s. So it's also relevant that the Bank of England was given a monopoly. So the government said, we're chartering a bank that's going to help us survive. And that bank is going to have a monopoly. There aren't going to be any other chartered banks in England or Wales. I'll come back to talk about Scotland in a minute.
I was going to touch on Scotland too.
But just in England and Wales, until the 1820s, there are no other chartered banks. There are private partnerships that are limited to a particular number of partners. So they have to stay small. But the chartering means that you can go out and publicly issue shares, have a very large size, and have the kind of reach that comes with that size. And in England, even though this was all happening around the beginning of the Industrial Revolution in the early part of the 19th century, this period was one where you could have made a lot of use of banks. In fact, in Scotland, they did make a lot of use of banks for private market development, but not in England and Wales, because the government needed the Bank of England to have a monopoly over sort of being the big bank that could mobilize savings and mobilize funding. For what purpose? To wage war.
That's right.
And so I have only one thing that I call Calomiris' law of banking. And it is that until a government feels like its survival financially is guaranteed, it will not start worrying about allowing banks to serve the private sector. And so while the survival of Britain was contingent and risky, and it was constantly at war with France, the role of the banking system as a tool of the state was to simply be a funding vehicle for the government. And that had many different pieces to it. We could go into a lot of them. It started off just as a debt swapping tool for helping to consolidate the government's debts put them in a more liquid form that would raise the price of the debts, lower the yield the government would have to pay through a combination of homogenizing the debt and also making it more liquid. So the Bank of England, it's very important that we recognize that it was a monopoly from 1694 to 1815, actually until the 1820s. And that wasn't a coincidence that was the era when Britain was continuously at war with France. And it was only after that ended that England and Wales could start to charter other banks. And what's so weird is, of course, just to the north in Scotland, the same king and queen are establishing a completely different regime, one in which the Scottish banks are not funding the government and are funding the private sector through a competitive chartering system in which banks are allowed to be chartered and actually take Scotland from being a poor country at the end of the 17th century to being a very prosperous and economically diversified economy that's operating on the global stage. And of course, people in England and Wales through that whole history of the 1700s and the early 1800s are saying, hey, what about us? How come we can't have that? Same king and queen, right? But the point is, it was a kind of triangulation where England and Wales served the purpose of funding the government. And Scotland, which had a lot of Catholics, there was a lot of concern about whether they would remain loyal to the battle, because remember, France was a Catholic country. And so it was a kind of triangulation. We're not going to impose the war burden on you. We're going to let you go off and do your own thing. Oh, but by the way, we're also going to dissolve the Scottish Parliament and force the Scots only to participate in the British Parliament, not to have their own separate one, which they had until 1707. So if you're trying to understand banking chartering, could you possibly understand it without understanding Britain's imperial ambitions, its war with France, and even things like Catholics versus Protestants?
Well, and then you had the Scottish Presbyterians as well, which very much didn't like the Anglicans, and so I've got to assume that also played a role along with the Catholics in Scotland.
And more generally, just that Scotland is far from London, always has had an independent streak. There was a lot of concern about keeping the Scots loyal, and which continues to the present, right? So. So I think that this is what we're meaning when you started us off and said, we can't really talk about this without talking about history. Those are the things we're talking about. Of course, everything is subject to change in history. But if you don't start with the reality of, well, there's such a thing as Scotland, and it's located here, and it's populated by these people, and it's different from England and Wales, you're not going to have a prayer of trying to understand this. You couldn't possibly understand differences in the chartering history of Scotland versus England and Wales based on some sort of economic efficiency analysis. Scottish banking was the great innovator of commercial banking in the world. They invented everything. They invented small denomination banknotes. They invented the clearing of notes. They invented interest-bearing deposits. They invented lines of credit. They invented clearing houses for clearing the notes and figuring out how to manage liquidity risk. They invented basically everything that we're still using in commercial banking was invented by 1750 in Scotland. So you might say, well, okay, all that stuff was, by the way, also branch banking. And so the Scottish banking system was known to America's founders and was known to everybody else. But it was especially known to people in England and Wales who wished they could have had it. But they were told repeatedly, no, you don't get that because we need to have the Bank of England in charge. And it's not until the 1820s that starts to change. And then when it does change, you start getting competitive banking in England and Wales. And of course, the Bank of England's fighting that tooth and nail. Like, wait a minute, we had a deal. What changed? But the British government says, well, what changed is the war with France is over. So, yeah, you were our friend. And by the way, Friendships are fleeting in the world of bank
They are.
coalition formation. So your friend yesterday, if you're the guy in charge, of this coalition formation, your friend yesterday is not necessarily your friend today. And when you look at autocrats, whether we're talking about Mexico in the 19th and early 20th centuries, or Mexico later, or Brazil during that same period, what I like to tell people when we're talking about these coalition formations is, for autocracies, often the definition of friend is the last person you'll stab in the back.
Correct.
Or it's not the first person you're going to stab in the back.
Right.
But it doesn't mean that you're not going to stab them in the back, because when you're in an autocracy, and of course, parliamentary Britain is not quite the same as Mexico under Porfirio Diaz or those kinds of things, but there's some similar elements. And the point I'm making is that your friends today aren't necessarily protected from your autocratic power,
Sure.
and so I think this is the fun thing to look at, is how technology and war and all sorts of things that are driving history are causing little changes in those coalitions over time that are reflected in what kinds of functions the banking system is permitted to serve politically, and then how that function translates into how productive are banks in mobilizing credit, and also how fragile are they, and how prone to crises are they.
So my understanding too, reading through your book, is that one of the reasons that England's system was fragile was there wasn't access to enough credit because of the monopolization of the banking system, and that when they looked north to the Scottish, which must have eaten them alive, by the way, that the barbarian Scots are engaged in unbelievable financial innovation, it must have bothered them so much that they had what you describe in the book as ample access to credit. Right. And
yes.
One big takeaway of your book that I wanted to point out is that it's not just situations like the United States where there was excess credit in the lead up to the financial crisis in 08 and 09, but that you can also have the reverse dynamic, which is the lack of access to credit, which is also just as detrimental, if not more at times.
That is such a great point. If I can just amplify that just briefly. So, this is a really important point. So sometimes kind of what I would call superficial and just wrong thinking says, banking crises come from excessive credit. Well, they can.
Not always.
They can. It can be that if politically you're getting rid of the discipline to limit credit, to do risk analysis, if you're subsidizing more credit as a political act, then yes, it's true, excess credit can lead to crisis. But then in many countries, the instability can come from limitations on credit, and that make credit scarce. There is no general mapping from the extent of credit to financial fragility. That is not true. So in fact, if you were going to say, what are the countries that have had the more frequent banking crises, developing countries than others? Democratic Republic of Congo and Chad would be examples. Argentina. What's true about those countries? Almost no credit. So it's not that there's a huge amount of credit. It's just that because of the structure of their autocratic systems in Chad and Democratic Republic of Congo, or their very peculiar democratic system in Argentina, that it's actually structured in a way that very much limits the availability of credit, but also makes credit very volatile and subject to problems. In the case of Britain, England and Wales at the time that you were discussing, because all the banks that were providing credit to the private sector were very small, it meant that they couldn't be as productively engaged as banks that could diversify. So if you're a small bank, it means typically you can't do a lot of different things. You specialize in a few things, and also you have a very small number of borrowers. So you're even within the sector that you're lending to, you can't diversify because your borrowers, you only have a
It's
handful of
inherently
borrowers.
risky.
So it's inherently
It's
risky.
inherently risky.
You can't, if you can't get scale as a bank, you're going to be
Mm-hmm.
risky. And so I think that this is just a fundamental point, that the supply of credit was very limited, but at the same time, riskier.
Now, they did, you said around, I think you said 1820. So then it sounds like Great Britain did indeed modernize at a certain point, and they allowed a more competitive banking system. Talk for a minute about that as well.
Right. So after 1815, France was defeated. And of course, people in England and Wales had been calling for competitive banking, seeing just over the border how well things were working in Scotland for a long time, since, let's say, it's certainly since the 1730s, 1740s. And so, but it wasn't until the 1820s. Now, there was a global financial crisis in 1825, and that caused, again, it had reverberations in England and Wales, which caused some bank failures. And people said, hey, can't we finally fix this thing? And that was the beginning of opening up chartering in England and Wales. And by the 1830s, it was much more open, and the monopoly of the Bank of England was eroded. And then by the 1840s, pretty much banking was now between England and Scotland was quite similar by the 1850s. So by 1850, they're not identical. They're still somewhat different, but they're much more similar. But that was just a natural consequence of the end of hostilities with France. There had always been a clamoring for allowing the free chartering of banks. The private sector always wanted it, but they didn't get their way until Britain was safely done with the French risk.
And then, did they go through a period of much fewer banking crises?
Yes.
In that time frame? Was it a much more stable banking experiment?
Yes. So there still was a major banking crisis in 1857. There was another one in 1866. So there were other elements that were still producing some crisis risk as the system was evolving, and we talk about all of those. The Bank of England was also learning how to be what it then became, which was a lender of last resort to the rest of the banking system. So it shifted from being mainly a funding source to the government as a monopoly bank to being a banker's bank. And there was some rough learning going on there, because if you start giving away subsidized loans, you might actually encourage some risk. And so we have a discussion in our chapter about that evolution. And then I would say by the late 19th century, let's say by the 1870s or so, Britain had developed a very subtle and the Bank of England had developed a subtle and rich understanding of how to operate as a banker's bank, a central bank. It succeeded very well in limiting crises. 1890, the Barings crisis is an example of that. And it's really not until you might say the 2008 crisis that they really experience another major, there were some minor ones, but another major crisis event. There were some other crises that we discussed in the mid 20th century, but nothing at that level. So I think
gained some stability.
Yes,
for quite a long period of time.
From 1866 until 2008, that's a long period, right? I would say that was a big success. In contrast, in the U.S., we had banking crises during that same period, 1866 to 2008. We had a banking crisis in 1873, 1884, 1890, 1893, 1907. There was a lot of banking instability in certain states in the 1920s. We had several waves of banking crises during the Great Depression. Then, of course, we had the savings and loan crisis. They had a little version of that in England. So you can see I'm running out of fingers here. Between 1866 and 2008, Britain was quite stable compared, for example, to the United States.
So this is a great segue point, and let me wrap a bow on Great Britain and just the advent of the banking charter. It is inherently a political situation. That
Completely.
was one of the biggest takeaways. That was the biggest takeaway I took from the book, that this isn't some purely free market experiment. This has been very much intertwined, and it's been a series of bargains, as you described them, with the government over a long period of time.
Well,
so now you transition to the United States, correct?
Yes.
And so many myths and misperceptions about the United States, and I think this is maybe one of the most misunderstood periods in American history, that banks were just fragile and they needed a Federal Reserve to back them up. And because they were inherently fragile, we had to have a new paradigm. But there's a lot more to that story. And you touch on, I think, two very important points that I was excited to dig into today with you.
Yeah.
And that's just also a political dynamic. So you've got the agrarian populist coalition, which we'll touch on. And then you've got this whole idea of unit banking.
Right.
I think some folks describe that as wildcat banking, that prevented.
Yeah.
They're
not the same. Yeah. But they're related, but they're not the same. Yeah. So unit banking means that a bank is constrained to only have one office. So it's unit. Right. It's a
no
unit
branches.
Bank. No branches.
No branching.
And so a wildcat, which is a pejorative term, and I would say a very controversial one. That is, I'm not sure that it is an accurate description of these banks, but it's part of a view that banks that were located out in the countryside sometimes engaged in a particularly risky, this is like on the frontier, not just in a rural area, but on the frontier, may have been particularly risky. I don't subscribe to the view that wildcat banks were an important phenomenon within the United States historically. I think that has been somewhat disproven by the literature on banking history. But let's talk about this. You nailed it when you said, yes, the key thing is to understand the rural populism. But I want to start even before that. America is a revolutionary country. And when the revolution happens, it defines the whole way that the playing field over banking and other incorporation laws and other kinds of things is going to proceed. We don't like centralized power. We just overthrew the British. And so we're going to set up a federalist system. And there's a lot of controversy between the Jeffersonians and the Hamiltonians initially over, should the federal government have a role in banking? Should it have a dominant role in banking? And, Jefferson was very opposed to that. Hamilton, of course, saw this as a good idea. And so notice, there's a divide from the very beginning between urban and rural. And you can use Hamilton as the urban marker and Jefferson as the rural marker, if you like. And that is, and so initially that urban-rural divide is playing out about, well, should the federal government, the national government, charter banks? And Hamilton wins that argument, charters the Bank of the United States. But its charter only ran for 20 years. And when its charter expired, the Jeffersonians were in charge, and they did not recharter the bank. Then we had the War of 1812, and they wished they had chartered it because it was playing an important role as a fiscal agent for the federal government. So they rechartered it, the second Bank of the United States, in 1816. But then when its charter is going to run out in 20 years, actually before its charter runs out, Andrew Jackson in 1832 decides that there won't be a rechartering of it, and it has to reorganize as a state bank. So the entire federal government's role in banking had to do with the chartering of two banks, each for roughly 20 years. And then after that, it's not till the Civil War the federal government takes a role. And at that point, it's not to charter a big monopoly, federally chartered monopoly that's going to operate through the whole country. It's just to have a federal version of local banks. So I really want to, can't go through all of the history here in a podcast with you, but what I do want to point out is there are two important facts that come from being a revolutionary country. One is federalism, and federalism means that you're going to have the states are really in charge. Hamilton's vision disappears. The Jeffersonian vision dominates. States are going to be in charge of the chartering of banking. And the second thing that comes out of that revolution is this distrust, not just putting states in charge, but distrust of urban kinds of areas. And the fact that America is an agricultural country for the most part is coming out of our history too. And what that means is that the coalition that's going to run things is going to be agrarian populists who are going to be fighting that battle primarily at the individual state level. So that you're going to have each state deciding what kinds of banks do we want to charter, what are they going to be allowed to do, and the winning formula for that is unit banking. And that's kind of itself a real. So I want to emphasize there's no other country that does this. It's just the U.S. The U.S. is the only country that decides to say banks are going to be structured, our whole banking system will be structured on the basis of individual states chartering banks, and then for the most part, those states are deciding to have banks that do unit banking. I want to just point out the antebellum period in the South is an exception. There's branch banking that's going on at the state level down there, which we discuss in our chapter. But let's leave that aside for now because that disappears after the Civil War. And so through U.S. history, roughly in the North, starting by 1810, but everywhere starting around 1865, until 1994, we're not allowing banks to be structured on a branching basis, even within states, much less across states. And so it's not till 1994 that we get a nationwide branching law that gets phased in by 1997. So I like to always, with my business school students, most of whom think the world started the day before yesterday, I'd say to them, how long do you think, you guys are all familiar with these big behemoths, Citibank, Bank of America, JP Morgan Chase. But how long, when did those banks were they allowed to set up branches anywhere they'd like? And they're, of course, completely shocked to learn that the answer to that question is 1997. And so until the 1980s, the whole thing got phased in through the 1980s and the 1990s. But prior to the 1980s, America was still a unit banking country. That is, the banks, wherever you lived, there was no nationwide bank that you could go to. And the beginning of this, it started to change in the 1980s. But my point is, this was a very peculiar institutional arrangement. And it reflected the fact that the dominant coalition initially, this changes in the 1980s, where urban coalitions, which have been growing in importance really for several decades, start becoming the political dominant coalition. But the rural coalition wanted unit banking. Now, why they wanted it is not immediately obvious, although I think we can understand it. If you were operating, let's say, a farm in central Illinois, you're growing soybeans, or maybe you're growing corn, or maybe you're growing both soybeans and corn. But that's probably what you're growing, because that's what you grow in that land. Mm-hmm. You're very undiversified. If the price of soybeans goes way down, not only did you lose money this year? But if it goes down and stays down, your land value will fall. So if you borrow from a bank and the price of soy falls, you might think, oh, I'm kind of in trouble. If that's a branch bank, it'll decide to move on to some other business and maybe take credit away from farming soy because it'll regard me as too risky. And so that's, I think, a good way to understand why agrarian populists wanted the banks to be tied to their locations. They wanted the banks to not have credit giving opportunities outside of the location because then the bank is kind of joined at the hip with them. We're all in this together. If the price of soy falls or the price of corn falls, yes, I might fail, but if I fail, you're going to fail too. And so that was, I think, the economic logic of why there was a belief that, and you could see this very clearly in what politicians were saying, that my local banker will be there for me when I need him, whereas a nationwide banking system wouldn't be. I want to emphasize the local banker is very risky because he's undiversified. He's small.
Correct.
And he's all specialized in this local product. And so he's going to fail all the time, just like you. So the farmers and the bankers fail together based on local environment. But the farmers preferred it that way. And it wasn't just smoke-filled room negotiating. So that, for example, in the 1920s, there was a referendum in the state of Illinois. Do we want to preserve unit banking? And it won. It wasn't special interest in the sense of, the banks themselves were paying the politicians to keep their system. It wasn't that at all.
It was a populist groundswell, wasn't it?
Exactly. And, you can see this. William Jennings Bryan, in the 1896 presidential election, he was the Democrat and Populist Party candidate. And he had three major items on his platform. And one of them was the preservation of unit banking. So it's not something that we teach in school very much, right? But most people could graduate from high school without knowing that this was a core.
Most people have never heard this, Charles.
Right.
Most people have never heard of this. In fact, I hadn't even really fully understood it till I took a graduate seminar in monetary theory, and the professor at the time, Dr. Hummel, was like, the reason we had bank runs, is because of unit banking. It was precisely your argument. And it was their inability to diversify their risk. And so, I'm from the Midwest. So if you're a bank and it's corn and soy, and that's about it, by the way, then if the crops fail, the banks fail, and then there's a bank run. And that was it's such an easy story to understand of why the U.S. banking system was so fragile and why we needed to diversify. I mean, if you had branches in other states with different forms of industry backing it, now you've got a much more stable banking system. Just a little anecdote. I was born in 1984, and I remember, a lot of the local banks in Indiana. And then all of a sudden in the 90s, Chase basically took over. Mm-hmm. Chase started to sprout up. All the little local bank that I used to go to up the road turned into Chase. And that started to spread. So I didn't kind of put the history together until I read your book of like, okay, it was actually when I was a kid is when it wasn't until I was, like 10 or even maybe even younger that this agrarian populist unit banking coalition actually started to dissolve and the banking system started to shift. So I think that's a really helpful. Any final things you want to add about the United States up until I'd say the late 80s before we switched to Canada here?
I mean, there are lots of nuances, but I think that we've really hit the core of the point. And we want to emphasize, I guess I want to emphasize how it changed that, in the 1980s, we had oil collapse. We had an agricultural banking crisis. We also had a real estate banking crisis. It was a there were lots of shocks hitting the banking system in the 80s. And so you could say, so that's what undid the coalition. But I want to emphasize there were similar shocks hitting the U.S. in the 1920s and 1930s, and we didn't undo the coalition. So the important thing is to understand also this history tells us this other really interesting point. Shocks coming from, economic prices or other kinds of things that are varying, like the price of soy or something, that can be a motivator for changing your way of organizing yourself. But it doesn't have to be. It's a wake-up call, but you can decide to double down if the coalition is sufficiently powerful, as it was, let's say, in the 1920s and 1930s. So we had
going to bring that up.
It just said, okay, yeah, everything just went to hell, but we still like it this way. That was the 19.
Exactly.
But what's interesting is in the 1980s, everything went to hell, and then it changed. So it's one of the things that we go into in our chapter is, so why is it that the first time they doubled down and the second time they
during
changed?
The Depression, for goodness sakes.
Exactly.
And that's the interesting part of it. And I think few people understand the dynamic of the Great Depression is that banks were failing because of everything you just said. They weren't diversified. I know there's other components.
There was some branching. So there was some expansion of branching at the state level during the 1930s. It did happen. There was some liberalization, but they kept the same basic unit banking system. They didn't allow that much branching, and they didn't allow branching across state lines. They kept the system intact. So we go into the combination of continuing urbanization of the population, which whittled away the political power of the rural areas, and also technological changes. The ATM undermined a lot of the benefits to the unit bankers of having a unit banking system. And so there were a lot of pieces. It's in history, it's typically not just one thing. When you're changing, you're doing a major tectonic change, it's more than one thing usually that's contributing to it. So, but that's one of the really interesting things to study is this difference between, on the one hand, the 20s and the 30s, and on the other hand, the 80s.
The other part, and I want to touch on it in a greater depth as we get to the financial crisis portion of this conversation, but then you layer in the advent of deposit insurance, which I believe started under FDR, and how that ramped up a level of moral hazard in that as a depositor, and frankly as the bank, because we know the bank's going to take more risks knowing their clientele is going to be bailed out, but even as a depositor, Drew Benson, for instance, in the 30s, I don't have as much incentive, particularly when they expanded insurance, I think in the late 60s. I don't have as much incentive to understand the inherent risk of the bank itself.
Right.
Because I know, hey, Uncle Sam's going to bail me out if
that's right.
He's going to pop in. And so I one of the things I wanted to point out that I think you're making this point in the book is that it wasn't also just unit banking, but then you throw in, as we get past the 30s, you throw in FDIC insurance. And this is kind of mind-blowing for a lot of people when I explain this to them, that FDIC and deposit insurance has actually played a role in ramping up systemic banking crises. And is that true?
That's true. Absolutely true. It first becomes important in the U.S. in the 1970s and 1980s, and especially in smaller banks. So let me try to do this quickly. So first I want to point out, when FDR was running for president, he opposed deposit insurance.
That was interesting in your book, by the way. I was actually surprised that he did that.
He was actually very well informed. He understood banking pretty well. He understood banking.
He did.
And he didn't want to have deposit insurance, but the coalition of rural interests was championed by Henry Stegall of Alabama, who said, well, look, I know you don't want to have deposit insurance. How about deposit insurance just for small amounts of deposits? Because my small banks in Alabama, that will help them. It'll have almost no effect on New York City banks because the deposit insurance is very limited. And he said, and we'll make it temporary. But then what happened was they kept expanding it. But the key thing there is they're limiting the coverage. But if you're a savings and loan, you have only small depositors. And so the first group of banks are ag banks in small towns. They have small depositors and savings and loans. Why is that relevant? Because small deposits are 100% covered. And so small banks, starting in the 70s and the 80s, when they get into trouble, they find that there's no discipline on them, that their depositors are not paying attention. The way the deposit market disciplines is some large depositors, often other banks, are noticing what's going on in your bank and they start to pull some money out. It doesn't have to be a run. It can be a gradual withdrawal. And that disciplines you. You start to have to deleverage. You start to have to manage risk because you know someone's watching. But if you only have small depositors who are 100% insured, as you just said a minute ago, then all of a sudden you realize, oh, when I have losses, nothing happens. These depositors don't take their money out because they know they're 100% covered. And so then I say, well, gee, if I don't do anything, I just got hit with a big shock. I might even be insolvent. This bank is going to probably be taken away from me at some point. So why don't I ramp up my risk and go for broke? That's sometimes called a resurrection risk-taking strategy. Because if I go big and I win, then I'm back in the game. So I have leeway because I'm not being disciplined. I don't have any uninsured depositors. I have leeway, and there's an upside out there. Let me go for it. And that's how you get small Texas banks and savings and loans going from being bust in the beginning of the 1980s to speculating on oil and on shopping centers in Texas and Oklahoma because they were effectively protected. So yes, you're right that the moral hazard problem of deposit insurance starts becoming important in the 1970s and 1980s, and it's definitely a part of the story. It's not just the U.S. The rest of the world starts to imitate deposit insurance because the politics in the U.S., it's a little different in other countries, but the political coalitions form there that are also in favor of some deposit insurance. So that's a longer story, but this changes in the rest of the world mainly from 1980 to about 2000. So, and slightly later. But just to
and
give
there's
you
more frequent banking crises based on some of the research I've read of yours, right?
Yeah.
Banking crises ramp up.
I'm not the only one. Yeah. So the finance literature has studied the relationship between deposit insurance and banking crises. And there is no question. The literature is unanimous. The more generous deposit insurance is, the more fragile the banking system is. And that's a problem for deposit insurance logically, because deposit insurance was created and justified as a way to stabilize the banking system. In fact, it destabilizes it. However, deposit insurance is politically very appealing still. So again, it's another example of where economic efficiency doesn't really drive the bus, but rather it's what's politically appealing to the coalition, the winning coalition. So deposit insurance is something where, as of 1960, there was only one country in the world that had it, the U.S. As of 1980, still only a handful of countries had it. And then all of a sudden, by 2000, pretty much the whole world has it.
And now we've got worse banking crises and more frequent ones. Correct?
Exactly. I mean, yes, some countries are trying to deal with this by limiting deposit insurance. For example, in Chile, they limit deposit insurance. It's been a very effective way to promote market discipline or to buttress their bank regulatory system. But it's still, on the margin, is very much a contributor towards increased systemic risk. Of course, there's more to moral hazard than deposit insurance. There can also be expected bailouts coming from programs like the U.S. government ran with TARP, or other bailouts, voluntary sort of government ad hoc bailouts of uninsured deposits. So that's kind of where the U.S. invented unit banking. The U.S. invented that because of rural pressures. Then it invented deposit insurance as a way to help the unit banks. That's Henry Stiegel. And then, so we if you think about this whole system, nobody ever argued unit banking was efficient. No one ever argued deposit insurance was, a good idea, in some absolute sense. Everyone understood that, hey, well, the Scots and the Canadians to the north, they're running nationwide branching systems that are very stable. We don't seem to need deposit insurance. Deposit insurance was the outcome that unit bankers needed to help them increase their stability without having to give up their unit banking system. So there's a lot to this story that makes you just shake your head. And you might say, well, what, don't we live in the best of all possible worlds where everything is determined by efficiency and what makes sense? And the answer is, Drew, no, we don't. We live in a world where bad ideas that are politically popular to the winning coalition can persist for many, many decades.
So this is super fascinating because this is just a story that is not well understood. And to quote your book, it's clear that the United States banking system was fragile by design for several different reasons and bad incentives, et cetera. But there are some countries that are not fragile by design. And you mentioned a lot of nations in your book, but I thought the chapter on Canada was really excellent, and I wanted to touch on Canada. They are not susceptible to these levels of banking crises. They've gone 160, 170 years now without a banking crisis. And even the one that is mentioned in the early 1800s was overflow from the United States and instability. And I love the history of this too, because again, one of the things that a listener needs to understand is that there's a historical set of circumstances that occur, sort of organic circumstances that occur that lead to these type of political coalitions that drive banking. And in Canada, the whole history of the French and the tension with the British, the fact that the British remained, that Canada remained an arm of the British Empire, and that there was a movement to beat back the French agrarian populists that were quite similar to the Jeffersonian populists in the United States.
Absolutely.
I thought that was very fascinating, just the history, even the St. Lawrence River and the way things got blocked from that standpoint. The last point I'll make, and then I want you to touch on this, is that there's all these interesting historical, in some senses, I don't know how else to describe it, but almost coincidences in a way that lead to these political sort of dynamics that exist.
Well, it could have gone a different way.
It could have, right?
There are historical accidents, you could say, things that could have gone a different way. So, for example, the French lose the war, and when Britain wins the war in whatever it was, 1768, I forget the exact date, all of a sudden, Britain has a country, Canada, which is full of French people. It's like 95% or plus of the population are French origin. And they hate the British's guts.
Of course they do.
And so it could have gone the other way, but it didn't. And then the American Revolution adds another element to this, because the loyalists who are not very happy with the American Revolution are looking for a new home, and many of them move to places like Toronto. And so just as America is the revolutionary country, Canada is the anti-revolutionary country, because the British are in control, and the British are saying, okay, look, we just won this country. We have to find a way to shape economic and other policies here that will promote Canada staying in the British Empire, not doing what the United States just did. And so Canada becomes the British policy toward Canada as something they just won is a policy of preserving their authority. And so they shape the population, but they're creating these, like Toronto, encouraging loyalists to move to Canada, and then setting up constitution provisions in Canada that are going to create centralization of power and eventually realize that they have to isolate the French Canadians. So they're not going to let, as you pointed out, if they had allowed the province of Quebec to operate as a separate entity and make its own economic policy, it would have blocked.
Wouldn't have been good.
It would have blocked Canadian development. And so they realized that. And so what they decided to do in the Constitution, as it developed, was to centralize all economic policy making, not let provinces have the power. So it's the opposite of the U.S. And they even have the opposite of our 10th Amendment, where any powers that weren't given to the central government, if they want it, they can take it. And so it's bank chartering is a national power. They also have a Senate, which is very conservative by design, and which is an important part of preserving the nationwide branch banking system. That many times the populist groups start to get control over the lower house, and they see unit banking and they want to imitate it, and the Senate vetoes that, blocks it. And so if you look at the Canadian history, though, you say, well, why is it? But the deeper point is, but why do they have that Constitution? And why do they have that Senate? And the answer is because they're the anti-revolutionary country. Their history is all about, and to this day, the United Kingdom still celebrates Canada Day. Canada is the jewel currently in their crown. It's an independent democratic country, but it's still part of the British Empire, and they still cherish it so the Canadian Constitution was designed to cement those ties, and they have persisted. And the Queen still appoints all the members of the Canadian Senate. Now, she does that today with the advice of the Canadian government, but now it's the King of England, King or Queen of England, is the one who decides and appoints the Canadian senators. So it's
wild. It's totally wild. I can't believe that's still in place today.
Look at the Canadian currency. Whose picture do you see on it? The King of England.
The Queen.
Right.
Yeah. Well, yeah. Now, I keep forgetting. We got the King. She was around forever, Charles.
Yeah, I know. She was around my whole life. King. So I think that this is like, it brings to life the point that you were making earlier about, which of course is the central point of our book, which is you have to pay attention to political preconditions. Some of them are kind of contingent. They're random. They could go either way.
Spontaneous per se.
And, it was very funny because the Canadian bankers were very proud of the system they'd created. Nationwide branch banking was highly stable. They've gone now over 200 years without a banking crisis. And the first chartering of banks was around 1816, and formally, I think, 1819. So the Canadian system, they're very proud of it. When they were training their bankers, they said, oh, by the way, don't listen to any of those people south of the border. They don't know what they're up to. If they try to tell you how to run a bank, don't listen to it. They're always having troubles down there. So it's very funny as an American to be reading the training manuals for Canadian bankers, making fun of the U.S., let's say around 1900. And let me also point out, Americans knew this. Just as the English and the Welsh were looking at the Scottish banking system and seeing what was wrong, in America, we could see that things were working much better in Canada. They were able to do things on a much more stable basis and to generate as much or even more in later years bank credit relative to GDP. So when we had our last major what's called the national banking era crisis in 1907, we established this thing called the National Monetary Commission to investigate how we could improve our banking system. So the National Monetary Commission commissioned these great studies. It fills a couple of bookshelves, right, of looking at each country in the world and looking at its banking system. And if you read through them, it's absolutely clear. Our unit banking system is just, what makes us different, and all these other countries are doing so much better. Germany,
so
the
they're
US.
They're acknowledging the inherent fragility of this.
They knew it was well known. However, they also knew that wasn't going to change. So in 1910, when they issued their report, they had a library full of volumes that they had created. That if you had said, well, what's the logical implication? Get rid of unit banking. But they knew that wasn't on the menu. And so what did they?
Because it was politically unfeasible? Is that why?
That's exactly right. So they didn't even mention it. All they mentioned was, well, we need to create a central bank. And that was the creation of the Federal Reserve. So the Federal Reserve, Canada didn't have a central bank till 1935.
And
Canada,
was the Fed just just the lender of last resort? Was that its primary function at the advent for these unit banks?
Well, it
to
was
create stability.
Actually, the main function of the Fed initially was to stabilize seasonality in the money market. And that came from our agricultural dominance. So that interest rates always went up in the planting season in the spring and in the harvesting season in the fall when farmers needed to borrow money. And so the Fed saw its
supply and demand.
Saw its job as basically helping the banks by supplying credit during the peak seasons to flatten out interest rates and to help manage bank liquidity risk as well as seasonal variation in default risk. And so the Fed was actually quite successful, but its main job was smoothing seasonal risks relating to agriculture. But what's so funny to me anyway is if you actually read what the studies commissioned by the National Monetary Commission prove, and then you look at their recommendations, you kind of scratch your head like, well, they had 3 books about Canada, 3 books about the United Kingdom. I think there were only 2 books about Germany. All of these books are being commissioned. They're all telling you, gee, we really need to change the way we structure our banking system. But they don't mention that. They just say, well, we need to create a solution to our seasonal liquidity problem. And
wow,
it's not that was a bad idea, but it's sort of like you wouldn't have had a need for that. Canada
but
did.
It's not the main idea. It's not the ultimate cause of the instability. It's sort of a downstream cause, but not the main cause.
Yeah, and I just want to emphasize, if Canada managed to have extreme stability without having had any central bank until 1935, and in fact, 1935, that's after the Great Depression. So I just want to point out, having a Federal Reserve was not really very important from a banking crisis standpoint. In fact, after the Fed's created in December 1913, we still had the banking crisis in the 1920s. We still had the Great Depression. We still had the 1980s. We still had 2008, right? So we
had 2022. We saw several waves of regional bank failures. Silicon Valley Bank, right? They've created a moral hazard problem. I would contend the Fed's actually made things even worse because it's yet another layer of the safety net that incentivizes unnecessary risk taking by the banking system. Does it not?
I agree. I mean, I think, certainly there's that effect. I mean, you could say that there's some opposite effects too, but it's a mixed bag. What I would say is that this is just, it's so funny, right? It's funny because when you look at our history, we're creating all of these institutions. We create unit banking for political reasons. It's devastating. We do nothing to correct it. Then we create deposit insurance to help preserve unit banking. And it's, and before we created deposit insurance, we created the Federal Reserve to help preserve unit banking. And so all of these things that you might regard as kind of, in fact, if you take courses in economics in school taught by economists who don't know much history, they kind of make it sound like economies necessarily, in order to be stable, have to have a central bank and have to have deposit insurance. So please explain to me why Canada managed to be so stable, even though it's a primary commodity, without deposit insurance and without a central bank. And so I'm not saying
that's such an important point, by the way. Just to stop you for a moment, it's such an important point because I think the narrative from the overwhelming majority of economists, and I think it's fair in saying this, is that and particularly from the Keynesian contingent, is like that is absolutely necessary for any form of stability without any sort of understanding of basic history. And that's what I appreciate about my monetary theory professor in grad school, is that he walked us through some of the history of of the 18th and 19th centuries, so that we had a greater grasp of why there was inherent banking instability. And it wasn't just that the Fed came and now we can just solve all the problems. And furthermore, we've had aggressive, post Federal Reserve, we've had aggressive financial downturns and banking crises from the Depression to the Great Recession in 2008 and 9. And so it's such an frankly anti-intellectual perspective that this is why I wanted to talk, because it's so frustrating, because that is what most people say, Charles. That's what most people say.
I agree. I do want to put my own views out there, which is I think that a properly constructed central bank pursuing a disciplined and systematic and transparent monetary policy is a good thing. I don't want to make it sound like it's not. I don't think deposit insurance is a good thing. But so it's not that I'm saying that the Fed is a bad thing, but the notion that somehow we need I think there's this kind of, what's the word I'm looking for, triumphalist way of thinking about history very superficially. You think, those poor idiots didn't figure out to create a central bank until 1913, and finally, thank God they did.
Had they known.
And then
they
didn't know until 1933 to create deposit insurance. And thank goodness for FDR, who hated deposit insurance. Oh, wait a minute. Right. I don't understand. Huh? What? So anyway,
I know.
So it's hilarious, really. But I hope that, your listeners will agree with you and me that actually once you sit down and just take a little bit of time, this isn't that hard.
Just a couple hours of reading.
It's not that hard, right? You can kind of see how things actually happen. It's not like this is a contested history. I'm a monetary and banking historian as well as a monetary and banking economist. And I can tell you that this is not like anything I'm telling you is contested. There's nobody arguing that, oh no, there's another story out there. There isn't.
Yeah, unit banking was surprisingly amazing. Like no one's out there saying that.
No one's out there saying that. No, we don't have one. In fact, if anything, the real problem is convincing people that I can formulate a coherent explanation of why anyone, including the rural populace, would have supported it.
If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.